Welcome everyone to another online content session for One-to-One Mining Investment Americas. Today we're very pleased to be hosting a great lineup of investors and advisors who are going to be discussing precious metals investing. As the COVID-19 pandemic has triggered significant impact on financial markets, we want to hear how are precious metal fund managers and investors interpreting this unique period. So joining me today, I'm pleased to be able to draw on the expertise of Lepard, who's partner at Equity Management Associates, Chris Mancini, portfolio manager at Gabelli Gold Fund, Dan Oliver, managing partner at Myrmikan Capital, Adrian Day, chairman and CEO of Adrian Day Asset Management. And leading our discussion today will be Jamie Strauss, who is the CEO of Digbee. Jamie has 25 years in mining finance experience, so we're in good hands for him to lead the discussion. Jamie was formerly a manager and managing director, at BMO, and is currently a non-executive director for Gold Standard Investors and other mining companies. So thank you everyone for joining me. And Jamie, I'll do a little introduction on Digbee as well, which I sort of missed off there actually. Of course, your focus is on transforming this industry with a new form of independent and objective research, focusing on the risks around mining corporates. So I don't know if you want to touch on that at some point, or perhaps before we start. But with that, I'll hand over to you to take us through today's discussion. So thanks, Jamie, and thank you, panelists.
Thanks very much, Adam, and welcome to all the panelists. Thanks for joining us. Maybe I'll just summarize the Digbee situation. Really, from 5 years ago, I just took a view that the industry needed some positive change to help us on our way. And the idea was to identify and mitigate risks earlier, improve confidence and improve execution. And I think everybody can agree that if we can do that and if we can achieve that, then miners, investors, and everybody can be better off. So that's really the background, and happy to meet anybody, miners or investors alike, at the conference. With that done, I'd love to just start off this. And I really want to encourage a debate here and a good discussion. I don't think anybody's short of hearing the word gold at the moment. Whether it's the FT who's normally negative or other articles or newsletter writers who are all positive, I think there's lots to talk on here. So maybe just start off with a macro question and the macro conditions around it. There's no shortage of macro issues going on at the moment. And I'd just like to maybe start off with Dan, whose background is as an economist, to give maybe a view on that, maybe identifying are we going to have inflation? Are we going to have deflation? The US-China relationships, which seem to go up and down on a daily basis, but particularly this week with regards to Hong Kong, they're losing special status in America. And also to some extent, a little bit on the miner side, the refineries, where there was shutdowns in the early part of the COVID epidemic, how that effectively addresses maybe the difference between physical and paper gold. So maybe Dan, if you just start off and then anybody else chime in, please, as we go through.
Yeah, sure. Thanks. Others have quipped, and I agree that if COVID hadn't happened, they would have had to create it. And what I mean by that is the issues really started last September with the whole apocalypse problem, right? And the Fed, don't forget, was printing money through September for quarter-end problems, and it was through December for year-end problems. It never went away, and then COVID gave them the cover they needed to print all that money. I mean, without that health crisis, it would have been really tough for them to print the money, but they needed to. And the reason is because anyone who understands Austrian economics knows that the only way you keep a credit bubble from collapsing is to continually accelerate money printing. And so that's what they've had to do. That's what they have done. But I want to point out that there's an enormous difference between the QEs of 2008 and 9 and the QEs currently. Now, in my view, gold doesn't like credit expansion. That's why gold did so badly for 10 years. It doesn't like when credit is increasing. It likes it when it collapses, like the 30s and 70s and those sorts of times. Now, what QE did in the last round, in 2008 and 9, was it wasn't money printing out of helicopters. It was giving reserves to banks that then use those reserves to go fund construction of assets like buildings and ships, and you get that Keynesian sugar high. You get lots of economic growth, you get lots of job growth until you get over capacity and it all collapses. This QE is not about that. No one's using this money to go construct new assets. They're using this money to pay their current expenditures. And right now what's happening is no one's going to work. They're getting the money anyway. And it's just basic Say's law. I mean, when you give money to people who aren't working in exchange for nothing, that money is sheer debasement. This is not credit inflation. This is currency debasement. We haven't seen the effects quite yet because the economy is still locked down. But in my view, as soon as the economy opens up again, all that money, and it's hard to keep count of how much it is, but $6, $7, $8 trillion of base money is going to go surging into the economy. And I think we're finally going to have the 1970s plus style inflation that we've been missing in the last 40 years. And that is, of course, the most fantastic environment for gold equities, because gold goes screaming higher, but because you're in inflationary depression would be too strong a word, but stagflation, your input costs don't keep up the way they did in the 2000s. And so you finally get margin expansion in gold mining equities, which has been missing for almost 40 years.
Wow, that's good. Who wants to debate against that? That's a pretty strong introduction.
Yeah, I wouldn't debate any of that. If I can, Jamie, let me just add to that, because you posed the question in the notes you sent us about, are we going to experience inflation or deflation? And my answer is, I completely agree with what Dan said, but I take it a step further and say we're going to have a little bit of both. If you look at the 1930s, you actually had 10% CPI deflation during the first part of the Depression. And I think that's the most analogous case to what we're looking at here. It's an enormous credit collapse of an enormous credit bubble. And so the demand, has fallen in everything. And certainly there will be deflation in lots of areas, including used cars, airfares, et cetera. And I could see the CPI going down substantially. And yet we all know there's enormous money and credit inflation in terms of the creation of the M2, and the money that Dan just alluded to has been injected into the economy. So, I think CPI is going to become an irrelevant measure of what we're talking about here, because what we're really talking about here is what asset do you want to hold in an extreme monetary debasement environment? And that's what we've got. We've got monetary debasement going on now that makes 2008 look like a kindergarten game. This is extremely serious. And so there's no doubt in my mind that we're not just going to see higher gold prices, we are going to see much higher gold prices, and that we can be experiencing inflation in gold prices and deflation in certain other prices. Certainly in gold terms, things could deflate, but in real terms, we're going to have a lot of inflation, and in money terms, we're going to have a lot of inflation. If
I can jump in just quickly and add to that thought, demand is, of course, way down, but don't forget about supply chains. I mean, supply is going way down too, because factories aren't working, they can't get component parts. And a lot of industries, like, for example, the cell phone industry, you think, well, supply and demand goes down, price goes down. Well, not necessarily, because when you run your factory at half capacity, all those fixed costs eat you alive. So actually your unit cost goes up. The same with the airline. Airline seats are incredibly cheap right now, but they're going to park half those airplanes in parking lots. And I think you're going to see the airline prices go up the wazoo in 6-7 months when things open up. So I think what's going to happen is that consumer prices after the panic period are going to go crazy. And that's going to be one of the things that finally gets the public panicked enough to go looking for alternate investments like gold to protect their purchasing power.
Good point.
Well, this is Adrian. I agree. Can I jump in?
Sure, go ahead.
I agree 100% with what both of you have said so far, but if I can, I'd like to just add two things. Another thing that makes this experience right now different from the experience with the QE and the QE2 and so on that Dan mentioned, but another difference, of course, is that after 2008, the Fed was paying interest on excess reserves, and there was a spread between what the banks could borrow from the Fed and what the banks could put on deposit with the Fed. So in 2008, 9, 10, it was in the bank, the money went directly to the banks, as Dan mentioned, and it was in the bank's best interest to turn around and put at least a lot of that money back on deposit with the Fed and earn a truly risk-free spread. And that's because, as Dan mentioned, the money was sent directly to the banks, not to businesses and to people. The other thing I'd like to raise, and it might seem awfully premature at this point, but how on earth do we ever get out of this mess? In 2014, the Fed said they were going to start to normalize the balance sheet and normalize interest rates. And 2 years later, they made the first, 2.5 years later, after saying they were going to normalize, they made the first very hesitant steps. And within a year, less than a year, we were back to increasing again. So if they couldn't get out of QE 1 and 2 and 3, which in retrospect look pretty small, how on earth are we going to ever exit this? That's a question I would pose, and I don't know the answer.
Chris, would you like to sum up on that rather challenging tripartite argument?
Yeah, I'd like to sum it up by saying I think everyone is right, and yeah, this is going to be a very interesting time, and it's true. I mean, this is something like we've really never seen before, and the effects are unknown. But what's known is that the Fed has printed lots and lots of money within the past just couple of weeks, and it'll be really hard for them to stop doing that. And there's a and money is being debased, and in that type of situation, like Adrian's saying, it's really hard to get out of that with the increased debt levels and the money debasement. And so it seems like this is a really good backdrop for the gold price.
Well,
if I can jump in quickly, and there's been no analogy in modern times for pandemic, but I think there is an analogy for what we're going through in France post World War I. And what I mean by that is a lot of France was flattened, and there was a big debate in the country back then in the early 20s about whether the losses should fall where they lay, or whether the central government should bail everyone out and pay for it all. And basically what you had was very similar to the United States. You had a left-wing party that wanted the government to pay for everything, and a right-wing party that refused to raise taxes. And so they printed the money, and the franc collapsed. And the only thing that saved it from complete collapse was the witness of the German hyperinflation. The French finally decided that they didn't want to go down that path, and so they raised taxes and cut the spending. But it's sort of where we are, where we have this catastrophe. There's always economic problems, and the central government is saying, don't worry, we'll pay for the whole thing, and we're not going to raise taxes. We're just going to print the money up. And history is pretty clear what happens at the end of that story, which is the currency collapse. And I think that's where we're headed.
I was going to leave this final, almost trick question to the end, but on the back of that, I was watching a Netflix film last night, and it just brought back the whole point about gold back in the 1930s and the US government forcing everybody to hand in their gold. Just based on what you were just saying, is there a risk that happens?
Well, if you're asking me, my view to that question that I get a lot is when FDR confiscated the gold, remember, he didn't just take it. It wasn't Bolshevism. He put a gun and handed it over. He paid you $20 an ounce, and then, of course, they defaulted on it. They raised 35. But that was in the context of the market down 90%, yielding with 10% dividend rates in a depression economy. If you were so obtuse that you hadn't already sold your gold to buy stock markets, he did you a huge, huge favor, right? When you look at the history of price controls and windfall profit tax in the oil business, it always happens right at the top, and before they even get around to passing it, oil's collapsed. It happened in 1980, it happened in 2008. So in my view, gold, unlike the 30s, is such a tiny piece of economy, and it's not like everybody has gold coins what they did in the 30s. It's just a few crazy people, hanging out in their basements, whatever, like us, with gold. By the time that is a threat and they have to outlaw it, my view is that probably we will have overstayed our welcome, and we should have been buying traditional assets, and at that point we'll be down 90%.
Okay. Anybody want to counter that?
I would agree with that. I would just add that gold was about 5% of people's assets and wealth back at that time, and today it's got to be less than 1/10 of 1%. I mean, nobody owns gold. If they go and confiscate it, they're not going to get any. Not to mention the fact that half the country is heavily armed, and those people own, a lot of the gold that's held privately. So, it would also be they admit failure of their current system, which people like the people who run our system are very loath to do. So Well, I rate it as a possibility. I don't rate it as a high probability. I think it's
and to Larry's point, in the U.S. it was illegal to have gold for over 40 years. The reason they legalized it was because the Keynesians had taken over, and they said, "Hey, gold is just a pet rock, right? We can't admit gold is money because the whole Keynesian monetarist framework depends on it not being money." And so they literally re-legalized, allowed Americans to have it because of this philosophical problem that they had. So to Larry's point, if they make it illegal again, they're basically admitting that the whole monstrous Keynes experiments and total failure. And where do they go from there? I mean, unless we're going full Bolshevism, and I don't think we are, I think that's a pretty low possibility.
Okay, I'm going to jump. Yeah, sorry, go ahead. Go ahead.
I just want to say one thing relative to that quickly is that, yeah, I mean, like Dan was saying, I think that, like, for my view and what I try to tell clients is that there's the potential for an eventual hyperinflation in the United States. And the outcome of that hyperinflation would be that the dollar would be tied, just like when there's a hyperinflation in Argentina, the peso is tied to a hard currency like the dollar. So if there's a hyperinflation in the United States, the dollar will be tied to have to be tied to something else because the currency is getting debased, prices are getting out of control. They need to tie it to something. They'll tie, the government will peg the dollar to gold at that point. But at that point, because of the hyperinflation that would have taken place, gold will be $10,000 an ounce, not $1,700 an ounce or whatever. $15,000. Dan probably has a better number, but whatever that number. Then at that point, maybe they say, just like FDR did, you know, we're guaranteeing now you will get $10,000 per ounce and no more, and not a real confiscation. I think it's, again, similar to what happened. People talk about confiscation, but it wasn't like Dan saying, you know, the army going to everybody's house and knocking on their door. So I think that it could actually, you know, turn out to be something like that in the United States, and that's what the gold price is pricing in. It's a probability of that eventuality.
Unless Adrian's going to chime in, I'm actually going to jump one question because I think a couple of those comments actually relates to allocation of gold into pension funds or other funds as a result of the coronavirus. And I'm just interested, particularly actually taking up Larry's original point there, is do you feel that the impact of coronavirus and the legacy of that is going to have a fundamental impact? We were talking just now about, I think 5% of people's wealth was in gold in those days. Are we going to see a generational shift now as a result of this, which we've all talked about in this sort of context for some time? Are we now going to see that? And will it have a lasting impact? Or is it more likely going to be a 1-2 year thing until we resolve this and it will then go back to where we were? Maybe Larry, you want to just follow up on that?
Sure, I'll take that. So I think, yes, it is increasing. I mean, the evidence that I'm seeing is that lots and lots of people are suddenly becoming very aware of a problem that they'd long ignored, which is debasement. I mean, in the Boston financial community, I'm getting more calls than I've seen in 12 years of doing this. And I don't think it's a 2-year event, Jamie. I mean, I think that basically, and this ties in a little with what Chris said, I mean, where's the end point? I mean, either we go all the way to full Weimar hyperinflation, the dollar's worthless, and I pray we don't go that way and we don't get there, or somebody intelligent in the government system eventually says, holy crap, we've got a big problem here. We need to do a one-time reset, and let's do a 5-for-1 split on the dollar, and the new dollar is going to be backed by gold before we run the country all the way to the bottom. I mean, it's possible we do. I mean, Churchill said it, you know, Americans will do the right thing after we've tried everything else. And you know, if we go to hyperinflation, then we're going to have something that's trustable. And that's why I laugh when people say, well, we'll go to an ADR-based system or we'll go to a crypto-based system or whatever. You know, bullshit. I mean, we're going to go to gold. I mean, 5,000 years of history, you know, if the currency becomes worthless, there's only one thing people are going to trust, and it's gold and silver. Mm-hmm. So there's no way this is a 2-year event. This thing has legs. What we don't know is how it plays out. Between now and then, there are going to be a lot of zigzags, and Dan has done some great work and has a chart that shows that the hardest part of one of these things is holding on to your positions because of the volatility. And it's going to be extremely volatile.
Mm-hmm. Chris, do you want to comment on that?
Yeah, I mean, I would tend to agree. I mean, I think that, you know, when I talk to clients and prospects, they say, what's the downside risk to gold? And the downside risk is, in gold stocks, is that we get this enormous V-shaped recovery, and everybody goes back to work. The Fed undoes its quantitative easing or lets its quantitative easing roll off. It starts to raise rates again, you know, and this is like, I think that's somewhat of a fantasy scenario. that is the risk of this kind of being a short-lived run for gold. I think, like Adrian was saying before, with all the debt outstanding, it's like all the debt that's been created recently for the fiscal stimulus, it'll be really difficult to ever raise rates. I mean, I think from a pension fund perspective, what I've noticed is that, we are getting some more calls from advisors who've been talking to clients and saying, hey, I'm interested, what's going on? I think the pension funds, from my perspective, they're kind of like they're pretty far behind in terms of getting involved, and they kind of they want to see someone else do it first. So I think what we'll have to see there is something like a very well-known pension fund get involved, like CalPERS will make an allocation to gold, and then University of Texas, and then Michigan, and then it's okay. Then we'll start to get some more interest in the asset class for the pension funds.
Interesting. Adrian, I want to come on. I just want to go back to a question, because I think we've really now kind of covered the macro scene quite nicely. I think you're all reasonably well aligned, which makes a moderating position quite easy. But I think, I think a lot of the listeners will be really interested in stocks and how the equities perform in this under this sort of scenario which you're painting. So I posed this question at a moderating back in, I think it was November. And I think it's fair to say that you've all highlighted from a macro point of view as to what's going to happen with gold very clearly. But on the stock specific situation, I go back to 2008-9, I think it took 9 months for stocks really to kind of gold equities to really start getting a bit of traction. So this is really what I posed before is, okay, we've now got a global epidemic. Worst case scenario, one could say in many cases. Money printing is a known fact. Record inflows into gold ETFs. Gold price up 140% since 2009. Gold supply up 35% since 2009. And Mark Bristow, the CEO of one of the largest gold companies, now saying he's looking at copper assets as opposed to just purely gold. Is this as good as it gets for gold stocks? The expectation has been so strong. We've now got all of this here. Maybe this is as good as it gets. Adrian, do you want to start off?
Yeah, I'll start. I don't think this is as good as it gets by any means. Now, maybe gold stocks are a little bit ahead of themselves in the short term, and we're overdue, in my view, for a pullback. Although I have to say that every time we have a strong market, the true believers are always waiting for that pullback that maybe doesn't come. But put that aside, gold stocks in the long term fundamentally remain very cheap. You look at gold stocks relative to their own price history, which is perhaps the least important factor, but people do look at price. As Oscar Wilde said, people know the price of things, but the value of nothing. You look at the price of stocks, look at the price of Barrick today at $25 versus $60 6 years ago, or Newmont down by over half over 2011. The gold stocks remain, in terms of price, very cheap. In terms of valuations, we're still in the bottom quartile in terms of price to free cash flow, price to cash flow. I think it's a new experience for most gold companies to have free cash flow, let alone earnings. But price to book value, etc., we're still in the lower quartile. And perhaps most important of all, gold stocks relative to bullion itself, we are not at the absolute lows. That was, a month ago, but we're very, very close to the all-time lows. And if we looked at a graph of that, you would see a huge gap in terms of the price of gold relative to gold stocks. So gold stocks remain very, very undervalued in my view. But if you add to that the fact that I think, if only temporarily, and we can debate that, the gold stocks, the gold companies have found religion. They are much more disciplined now. They are much more focused on profits and free cash flow as opposed to just getting bigger for the sake of getting bigger. Again, I don't know how long that's going to last, but for now, they found religion. And then lastly, add to that the fact that foreign currencies, what we call the commodity currencies, Australian dollar, Canadian dollar, Brazilian real, South African rand, and so on, are very, very cheap. And that combined with a low cost of oil makes the costs of producing very, very low. So I think right now is a sort of a perfect storm, if you like, or what the opposite of a perfect storm is for the gold mining companies. I don't think in any way that's a short-term phenomenon, or we've ended. This is as good as it gets. Absolutely not. And I think, if I may just close, the difficult thing for people who've been around the gold market for so long, not so much for gold fund managers, because our mandate is to invest in gold and gold stocks, but for retail investors, particularly who've been around this market for so long and had so many false starts, the difficult thing is, to make that attitude adjustment, if you like, and realize this is a longer term phenomenon and not to be too quick taking profits.
Excellent. Thank you very much. Who wants to go next? Dan, would you like to comment?
Yeah, I'd love to. I mean, I completely agree on the long term. What makes me nervous is that no one seems to be arguing the counter side. I remember I was in a room in 2011, I guess, and people were asking where gold was going to be in 12 months, and everyone thought it was going to be 2,000. No one thought it was going to be 1,000. Of course, 1,000 is where it wound up. So market had a way of disappointing people, and I think the last time Barrick made a big copper acquisition was right at the top of the market before they collapsed. So that makes me nervous too. I think long term, you have to understand what you're buying when you buy gold stocks. Gold stocks is a anti-credit trade. You think about, gold stocks did incredibly well in the 30s during the deflation credit collapse. They did incredibly well in the 70s during the inflation credit collapse. So they don't really care about inflation, deflation. What they care about is what's happening to the level of credit. And I think, as Chris mentioned earlier, the risk is that we do get some big V-shaped recovery. And what my short-term concern is that it could look like that. With the money they printed, it's possible they open the economy, everything's roaring, and the market is doing great, everyone's spending money, and everything great. And of course, after that, I think we're going to have massive inflationary impact, but that may take a few months to manifest. And so I could envision a few months of choppy waters because the trade is so overcrowded right now, and because the restart might look good. But again, I think long term, there's no question in my mind that we're facing a credit collapse, in the sense that when you print $7-8 trillion of base money to cover up your credit problems, that is what a credit collapse is. You're replacing credit with base money, and gold is doing incredibly well. So I think people get hurt in the space because they over-allocate to it because it seems too obvious. And that's the danger, is managing volatility, understanding what you're buying, understanding that you don't want to be all in because there might be pullbacks. But as Adrian says, you don't miss it either, because they don't have to pull backs. When gold goes, it really goes. So you got to be part of it when it takes off.
No, it will be volatility, no question about that. And I always remind my investors, look back to 2008. From October 2008 to March of 2009, which was October was when the gold stocks bottomed, March was when the S&P bottomed. In that period, just 5 months, the XAU went up 120%. The XAU index of senior mining companies went up over 120% in 5 months. But along the way, there were 3 pullbacks of over 20%. I mean, that's pretty astonishing to think about. When you look back at it now, you don't even see those. But living at it at the time, everybody who was managing money said, oh my gosh, is this the end? Maybe I better get out of it now.
Well, so to me, that's very simple, is might as well go with the experts and stick to those who've done this for some time, and you guys seem to be the people to do it. So that's probably the best advice. But Chris, do you want to comment on the issues outstanding? I mean, is this as good as it gets, or when it comes down to the stocks, or are we going to go forward? Could I just say one thing? When I mentioned Mark Bristow, obviously we shouldn't paint Mark Bristow with the dirty tar barge of Barrick some years ago. What I was really talking about is Mark Bristow from the old Randgold days, who's quite good at picking tops and bottoms, and therefore his choice of a copper asset, or suggestion of a copper asset, is he calling the top in gold under that basis? That was really the purpose of the question.
Sure. Yeah. Well, I think relative to the Barrick and Mark question, to get that out of the way, I think that he's being from my understanding from having discussions with him, kind of what he's thinking about there is doing big picture. I think he would like to eventually merge with Freeport and then create a copper co and a gold co, and the gold co would have Grasberg, which is currently the biggest or one of the biggest. It produces like 1.5 million ounces of gold per year. So it's an enormous gold mine, although it's within a copper company. So, and it's a world-class asset. So I think that's kind of Mark's thinking. I don't think Mark's really saying that he thinks that gold's top tier when he's thinking about copper. Again, I think he's thinking more strategically there, and he's dreaming, which is what Mark's really good at too. And as you say, Mark's great, and he's I think one of the best CEOs in the industry. So that being said about that, I think that is this as good as it gets? I think the answer is it's a really good time right now, especially because gold, the input costs have come down so much, like Adrian was talking about, the currencies and oil. I think that it could get a lot better for sure, and that's really going to be a function of what happens with the gold price. And like Dan was saying, I think there's a good chance that the gold price increases with input costs kind of staying somewhat flat for a while. And so, even relative to like eventually, say if you're mining it now, this isn't happening now because you have to get the skills trained. But even in some place like Nevada, where there are huge layoffs in Las Vegas and they're mining in northern Nevada, there's the potential to get people who are unemployed in southern Nevada to northern Nevada. And so they're although the gold mining industry might be booming, the hospitality industry might be suffering. So it's a very good time to be a gold miner. And I think the opportunity from a valuation perspective now, there are more opportunities in the juniors, in like the junior producer space than in the big producers like a Barrick or a Newmont, because I think the fast money just flowed into those big names first. And I think that if the gold price kind of stays here, goes higher, I think that the smaller producers will kind of catch up to those.
Jamie, let me react to the "is it as good as it gets" comment. I'm going to take the bull side of this. I feel very, very strongly, pound the table, that even the fact that we're asking this question reflects something that's gone on in this market, which is we've lived through a brutal bear market from 2012 to 2016. We popped out of it, and of course, then we got popped in the nose. And so, what I think has gotten created in this space is what I call battered gold stock investor syndrome, which is the minute it starts to work, we're all terrified that it's going to stop working. And I'm certainly in that camp. And I know the fact that we're all asking that and looking over our shoulders, I actually think this might be one of those times where we kind of get surprised in the other direction, which is not to say we couldn't have Adrian's 20% pull down or even perhaps a bit more than that. But I look at this in terms of optionality and asymmetry. And, I see this as a 50% down, as an absolute worst case. And hey, we experienced that in March and it was pretty damn brutal. But I think it's kind of 2 to 5x on the upside, at least. If you run that ratio chart of, pick any index you want, Huey to gold price, GDXJ to gold price, GDX to gold price, we're way, way down below the longer term average, to the point where these stocks could double from the level they're at now and still be very much within the fair value range. And this is at today's gold price. Flex the gold price up and the numbers get even better. So, I would say to anybody looking at it thinking, well, I'm going to buy the dip. I've got nothing. I'm going to buy the dip. I think that's a huge mistake. Dollar cost averaging in, yeah, probably makes a lot of sense. Then if and when this pullback comes, and certainly there will be some, you buy the dip. And that's what I think we're in. I think we're in a new bull market where the proper way to look at it is buy the dip.
If I can just add to that comment, on the junior side where I mostly operate, they haven't responded nearly as well as the majors, as Chris pointed out. It's easier for fast money to come right into ETFs and buy the majors. And everyone's wondering, well, how high does gold have to go before these things perform? And I think that's the wrong question. If you look at any of these projects that the juniors have, they're fantastic at current prices. Just knock your socks off. That's the problem is, where's the capital? There's the bear market was so brutal that there's only a few shops that provide capital for these projects. There are way more projects than our capital, and so the pricing is horrible. But that's already changing, as Larry alluded to himself, and I've seen it too. A lot of generalist money hasn't deployed yet. They're kind of hunting around, trying to figure out what's going on, how to get into the space. And the second that relationship inverts, when there's more capital chasing these projects than there are projects, the pricing is going to change dramatically overnight, regardless of the gold price. The nice thing for us is that there's so much capital sloshing around out there that the Fed's created looking for a home. And a gold project, it takes years to develop these things. So the supply is very inelastic. And so again, once you get enough generalist capital scared into the space, I think the juniors are going to catch up and surpass the seniors very, very quickly. And you've got to be in them or you're going to miss it. Now, again, I mean, you got to manage allocation because it is volatile. But when that step change happens, you'll just miss it if you're not already part of the trade.
So if I could just take that one step further and slightly nod off the sheet which our kind hosts gave us, but I think we scared away so many people from the last bull market. And we've gone through such a brutal bear market, other than just price of gold. But with all these ETFs and everything else that has come by, what is it that needs to happen, or what do we need to have that gives the confidence back to generalists to allow them to invest in stocks which, let's be honest, are generally regarded as high risk just by the nature of the business? What is it that needs to be done? And I'm slightly talking here with my hat on as a CEO of Digbee, where I'm trying to make due diligence or analysis of these technical risks, geology, metallurgy, engineering, simpler for people to read and more objective and more appropriate. But I mean, what is it? Is it management? Is it just the gold price? What is it that needs to kind of give people the confidence to do that?
I could take that. Yeah. So I think that what it'll take, I think that like Adrian was saying, the companies haven't ever generated free cash flow, and they're starting to generate free cash flow now. And we're also in an environment where we have very low interest rates, obviously 0 to negative. So I think that if companies can start generating free cash flow and paying dividends and actually generating income. And so if you have a scenario where you have 0 interest rates around the world, and then someone says, well, wait a second, there's this gold mining company that's paying, the yields right now are low. But, I think, for example, Newmont, the big guy, they pay $1 a share. At current gold prices, they could double that or even possibly triple that to $2 or $3 a share. So it's someone who says, and they're small companies that we own that, again, like generate a lot of free cash flow or trading at discounts to their net asset values, and paying very small dividends could increase the dividends. So if someone says, okay, I'm getting 0% in my bank account or treasuries or whatever, or 50 basis points or whatever it is, as opposed to, 2%, 3% in this gold mining equity where the gold price is actually going up and that dividend, that amount of income is actually going to be increasing. So I think that's what it'll take, I think, this time around to get generalists involved. And I think that the companies are actually well positioned for that, thankfully.
So, Chris, sorry, go ahead, Dan.
I'm going to offer a more cynical view, which is that in terms of the juniors, almost every project that is in the market today survived 1250 gold, right? That was a real stress test. And so at 1750, they're all payable. And I think what happens is that the first movers are going to make a tremendous amount of money on the existing stock of junior companies, and that'll draw in all the sideline people, all the greedy people, and then they'll all buy the crap in the euphoric time at the end. I mean, people, generalist investors sell in despair at the bottom, and they buy euphorically at the top. That's just how it works. I mean, Mark Twain said that a mine is a hole in the ground, the lion standing on top. Nothing changes in markets for human nature. So that the opportunity is now when you're pretty sure that all the companies around today are legitimate. And again, after they've all gone up 10x and the new guys show up, that's when you start worrying about what you want to buy.
Okay, so I'm going to pose an extension of my original question to Larry and Adrian here, based on what you guys have just said there, is you've given a very good explanation of why the producers should go up and why the generalists should get in, which will help, obviously, the producer share prices going up. but from a risk point of view, obviously every one individual is different, and talking generically here, is where do you see the best value at the moment? Is it the producers, is it the developers, or the explorers? Because we've had this bear market for the last 10 years. There's been little cash around, but as you quite rightly say, these guys have survived. Where's the best value for your buck at the moment on a generic basis in this industry? And I'll start off with, I know, Adrian, you go for it.
Oh, okay. You know, I think we're going to see a continuation, maybe for 3-6 months or even more, where the senior producers, as well as the major royalty companies, which we haven't mentioned, and let's not forget the royalties, eh? I think new money is going to continue to flow into the big producers and into the big royalty companies. But as the market progresses, and we're maybe, you know, we're already seeing some of the junior producers, as I think Dan mentioned earlier, we're already seeing some of the junior producers begin to move. And, I could think of several in our portfolios that have doubled or more in the last 2 months, as have the seniors. I think it's going to be a while, though, frankly, before we see the exploration companies really pick up. People have been so hurt. I mean, there's a natural market for those stocks. And that natural market for those stocks has been hurt so many times in the last 5 years. And I mean seriously hurt. You know, when you're hurt in an exploration company, it's not a 5% haircut. You're down 80, 90, 95%. So I think it's going to take a little bit of time for people to get back in there. But the catalyst will probably be 1 or 2 juniors making a discovery, being bought out, another discovery, another buyout, and then people will begin to have a little bit more comfort. But that's probably at least 6 months away now. But, you know, maybe that's where the best value is as well.
Hey,
Larry,
Jamie,
do you want to sum up on this? Yeah.
Yeah, to answer your question on best value, it kind of depends on, it should be best value against risk, right? I mean, the big companies are probably the best value against the risk, but they're more expensive and they're not growing their production. You know, the way you add value or fast, but obviously in a more risky fashion, is you grow your production, you have an economic project and more economic projects in the pipeline. You get a higher price of the metal, which we all expect. But most importantly, you get multiple expansion. And so you can find, and I've found, and Dan has as well, you can find good producing juniors, and this is the preponderance of my portfolio, that are trading it between 1 and 5 times, 1 and 5 times run rate cash flow, which is rather stunning. I mean, compare that to Google or Apple or Facebook. I mean, they're all trading at 100 times in a 0% interest rate environment, an implied, EV to cash flow yield of 100% or 30%, or a lot of cases more like 4 times cash flow, but 25% implied EV cash flow yield, that's stunning. And, you need to know the situation, you need to know the people, the political risks, the geological risk. I mean, that's why, Jamie, businesses like yours are going to flourish in the next 5 years. But if you know that, I've got 5-baggers laying around all over the place, assuming that gold doesn't go to $1,000, which I don't think it's going to.
Okay, that's so that I think leads us on really nicely to really the religious question, which I think Adrian commented earlier, is all these majors and everything have got their religion. They're there. They're keeping their hand on the underneath, on their chairs, so to speak, and they're not doing a big M&A spree as a result of the historical issues, which we all know about, which ended up with a huge amount of write-offs. However, we're actually seeing quite a lot of M&A going on underneath the surface. We saw the TMAC one the other day, for instance, etc. So are we going to lead ourselves ultimately with this rising gold price that you're painting? Are we leading this to an obvious situation with reserve lives as low as they are, with cash flows bubbling over the top? Are we going to lead ourselves into an M&A boom, or is religion going to carry on? Chris, looks like you're desperate to get going.
Right. I think that the M&A will be subdued for a while. So we saw the earlier, I guess a couple months ago, Endeavor bought Semifo for a premium, and on that day Endeavor stock got hit really hard, and so it turned out to be close to a nil premium. And then shortly after that, I forget, a few weeks ago or something like that, the SSR and Alistair merged in a nil premium merger. And so, and then even the TMAC, that was a distressed asset, and they bought it for not much premium at all. The Chinese did. They almost kind of took them out of their misery. So I think that what we're seeing is that the companies right now who are making acquisitions at premiums aren't being rewarded. And so I think that, and then like we saw the SSR and Alistair merge, and I think that they were hoping that they would do this nil premium merger and that both stocks would re-rate higher. And that didn't happen. It hasn't happened yet, but like with the Barrick and Randgold, like you were talking about before, Jamie, where after that deal happened, both stocks went up like 30%. That hasn't happened yet for those two, and I think that there might be reasons for that. And so I just think that right now the companies, the bigger companies, are being rewarded for staying the course, paying dividends, doing trying to find organic growth projects, and that's how they're getting paid. But I think eventually it'll come to the point where they're going to have to do something. But I think we are a ways away from it in terms of having a decline. Like they don't want to have a declining production profile. So as long as a company can maintain its production profile for a couple of years before it has to start building the next mine in order to maintain the next the production profile, I think that they'll stick with that. And especially when no one else is doing anything, because they feel like they'll have the opportunity to wait. But I think that it will take a little bit of time, and someone will do a deal, and the one of the good assets will be gone, and then the next good asset will be, and then it'll start to heat up. But I think that we're a little bit away from that. Like
okay.
If I can jump in, one problem with modern capitalism, our system, is that executives are mostly compensated with call options. And just thinking about Black-Scholes, the easiest way to increase the value of your call option is increase volatility of your share price. And the easiest way to do that is take debt on. So in every industry, not just gold industry, but every industry, the senior executives are incentivized personally to take on debt and make acquisitions. And I think so, to your question, M&A, I mean, yes, there's going to be an M&A boom because managers are always incentivized to do that. And what's going to happen is that the first deals, as Chris mentioned, hasn't had that much zing yet, but to the extent the gold keeps going up and the expenses don't, those deals are going to look fantastic in retrospect. And so as we get momentum here, there's been more and more appetite from the banks and other financiers to fund these M&As. And again, there's always incentive for the managers to do it. So all you need is a conjunction of those two things, and we're going to see a huge boom. And part of it, of course, is driven too because, as you mentioned, reserve lives have collapsed because the majors had no money for the last 10 years to explore. And the easiest way to increase mine life is to buy someone else. I mean, it's very hard to go find your own gold, much easier. And when you're some big company and you've got access to cheap capital from the banks, that's what you do. It's just a cost of capital issue. The medium companies, the junior companies, have a very high cost of capital, and the seniors have much lower. So it just makes sense. You see it in every cycle, and you'll see it this time too.
Let me add to that. I think that what's going to happen here is a lot of these big guys are going to look at it and they're going to do a build versus buy. And in a lot of cases, they can buy ounces in the ground for a fraction of what it would cost to drill them on their own, because a lot of money has been spent drilling these ounces and they're sitting there. So I think a lot of these companies are going to get picked off. The problem from my point of view actually is that, and I look at this a lot in the companies I pick, I want the share structure to be people who are gold bulls and believe longer term, because I think getting picked off at a 30% premium on an asset that's about to do a 5-bagger, that doesn't really excite me. I mean, I think Continental got stolen. I think Atlantic got stolen. I think TMAC got stolen. These are multi-generation assets that would last for a very long time. And because the shareholders and the management were tired, they sold out. And I think that's a shame. So my view is there's going to be a lot of M&A. It's probably going to focus more on the smaller drill stories. I mean, I'm in drill stories that are trading at $5 at a proven ounce in the ground. I mean, that's ridiculous. It's absolutely ridiculous. And my great concern is that the management of that company will demand a high enough price. I mean, sure, I might get 2x my money, but I want 7x my money because that's what it's worth. So I can see the acquisitions coming, But in some ways, I view that as a negative thing.
So, Adrian, do you want to sum up the religion argument then on that basis, as you posted initially?
Well, M&A doesn't have to be, M&A can be good, obviously. I mean, there's buying good acquisitions that make sense for the company. When I was making a reference to, 2011, that was overpaying for marginal assets, and we're years away from that. I'm cynical enough to think that when gold's 2,200 or 2,500 and people are clamoring to the companies for growth, because they will be at that point, I'm cynical enough to think that they will lose that religion and go out and overpay again. But in the meantime, I couldn't agree more. We're going to see more and more of this M&A. And was it Chris made the point? I think it's a good point. Something will get picked off. And someone on the board of directors will say to a CEO, weren't we looking at that? Yeah, we were, but they did it first. Okay, well, let's not let that happen again. And I think once you get this one go, then that one go, then you start to get a little bit of a frenzy. A frenzy is maybe too strong a word, but you get a little bit of a race among the companies to make sure they don't miss out on buying the assets, because there's only so few good assets around.
Mm-hmm. I think no webinar these days is complete without entering ESG into it. And I think just on M&A, it's an interesting, I just want to ask a question to the panel on this is, do you feel as though the impact on ESG is a deterrent to allowing a potential M&A environment to evolve? And what I really mean by that is the junior industry, which is so important, particularly the gold industry with its lack of reserves available. The junior industry is so important to the major industry to sustain life, shall we say. And there's been obviously a bit of a lag to get these companies to sign up and get ESG reporting, not necessarily ESG in principle, but ESG reporting getting out there. Do you feel as though that's a deterrent for the majors who don't want their own scorecards to be blemished? Adrian, you're still on my screen as the kind of main talker, so why don't you start off?
Well, I can't really answer to that. I think some of the other people would be better able to answer to that. I will make one quick comment, if I may, on ESG, which might ruffle a few feathers. You mentioned, their ESG practices may be okay, but the reporting isn't so good. And I think one of the problems with ESG today is it's become a little bit of a box checking exercise. Let's face it, most mining companies, most, not all, but most, they have it inherently inside them to take care of the environment. They want to take care of the people. Now, there have been a lot of mistakes in the past about not so much environment, frankly. That's only, East European communist mines that have problems. But there have been companies that have not taken enough concern about the local communities when they go down, because you need to get the local community support. And we've all been on mining trips where we can see the difference between the guys that come down from Toronto and immediately everybody comes out and hugs them, and the cook says, "Oh, I've made a special tamale for you," or whatever it is, on the one hand. And on the other hand, the three guys that come down in their Brioni suits, and everybody turns up, everybody walks away. Nobody wants to talk to them. We've all seen that. But I think the truth is most mining companies today do take care of ESG, but they may not do it, they may not have the full reporting and the full memos. But I think a lot of it has become, very bureaucratic and box checking, frankly.
If I can jump in and be a little provocative, I think ESG is a rich man's problem, and to the extent that people become a lot less rich, they're going to care a lot less about that. And we, mining went from the 1950s, when it really was awful, dumping stuff in the river kind of thing, to now the pendulum has swung way too far in that direction, where it's you pay crazy amounts of money to save 2 turtles and that kind of nonsense. And so I think that, again, as the wealth or the perception of wealth dissipates in the West, people care a lot less about that as part of the I mean, all that environmental green nonsense is part of the neoliberal fascist political economic system we live under. And that's the point. That's going away. That's what gold is going to do, is clear all that deadwood away. And if the majors are too sclerotic to make acquisitions, then some aggressive intermediates will. That's just the answer. Economics defeats statist power. That's the main lesson of history. So I think that the mining companies won't become more irresponsible, but I just think that the absurd rules that have been applied over the last few years will just start to be ignored and go away.
Okay. Anybody else want to comment? Chris?
I was going to say, I mean, I think that a lot of, I think that it depends. I mean, to answer your question more specifically, Jamie, I think it depends on the project and on the operation that they might be acquiring, because like, I think that Newmont, for example, in their acquisition of Goldcorp, I think that they saw and they see a lot of opportunity to improve on Goldcorp's practices, and actually, you know, even to a degree, get some kind of operating synergy out of employing their better ESG practices than Goldcorp. Like, for example, at the Penasquito mine, the hope is that now that they have an agreement with the local land group, that there won't be the disruptions in operations that there have been in the past with Goldcorp. So I think that from that perspective, I think they see it as an opportunity. I think if it's some big, you know, project that the NGOs have gotten all over and are waving their flags about, then it might just be more of a deterrent for them, because they don't want to deal with again, these are guys, they like the board members, and they don't want to have to deal with protesters at their annual meeting and things like that. So, but I think that by and large, I don't think it'll scare them away from projects where things might have been kind of where, a junior doing something on a bootstrap might have been a little bit remiss in their practices. They might see that as an opportunity.
Well, Pan American and Tahoe is an excellent example with the Escobar in Guatemala. That's an excellent example of what you're just saying.
Yeah, exactly. Yeah, yes, exactly. Yes, thank you.
But
I mean, that's their
they
hope.
can improve the situation. Yeah.
Exactly. And exactly. Thanks, Adrian. Yeah, I mean, and Pan American says that they had that, their pitch on the whole deal is that that's their expertise is ESG in Latin American countries. And so that, for people who don't know, the Escobar mine in Guatemala has essentially been closed by the government. And I think that there were some mistakes probably that were made by, in hindsight, again, these juniors, Tahoe was doing things on a bootstrap budget, and it was, and they tried to do the right thing in terms of paying different communities and paying them royalties, but then one community didn't want the royalty, and so they were kind of left out, and then they said, okay, let's close them, and it got very ugly. And I think that Pan American's taking a big step back and saying, let's try to reassess this from a holistic perspective. And that's a great example that Adrian brought up, is that, yeah, like that's the whole essence of that deal. Of that acquisition.
Interesting. Lawrence, or do you want to sum up on this, or should you go?
It's just not something I've focused on a lot, rather embarrassingly. I mean, I'm glad to see that all the miners have become so much more ESG compliant over the years, but probably like Dan, I think it might have gone a little bit too far in some areas. Okay. But I think I'm all for very responsible mining, but I think a lot of people have been doing that for years. The bad stuff was many years ago, in my view.
Yeah. Well, this is a precious metal stream, so no precious metal stream should relate only to gold. We're not, I think, going to cover diamonds today, but I think we should cover silver just quickly. I think the question really, which is posed, is how do investors approach the silver equities within a diversified portfolio? And are there enough quality projects out there? I think, Eric Sprott recently put $60 million into MAG, going into production later this year, which was interesting from my perspective. The most successful report we've actually sold is on the Juanicipio asset. So it wasn't entirely surprising. So I'm just interested in how you guys see silver within your portfolios, within your precious portfolios, but also from a generalist point of view, and how they might approach this. Who wants to go first? I think
I could start. I mean, I think that generally speaking, I mean, the way that I like to describe it is that silver is, so from just silver relative to gold, silver is the poor man's gold. It's, you know, when gold really runs, and we saw this in 2011, when gold runs, silver will catch up. And I think that that's partly because when like retail investors get interested in precious metals, they say, okay, I can either get, you know, 2 coins for whatever, $4,000, or I can get, you know, 50, you know, whatever the number would be, 200 coins, right, for $2,000. And they go, I want the 200. And then, and I think that actually does happen. And I think that that's why silver tends to catch up to gold. So I think that that's the play. If gold keeps going and more generalist and kind of retail investors get involved, I think silver will catch up. From an equity perspective, I mean, the difficulty is that there aren't a lot of primary silver mines in the world. And so, and then I think some companies do stretch because they want to be the silver producer. They might kind of bring on kind of, you know, sub-quality assets or poor quality assets because they want to be the silver producer. And so you have to be careful. We own MAG because that is a great asset, and it kind of happens to be a silver producer. So I think the way to do it is to really more so focus on the asset and the asset quality. And if it's gold or if it's silver, we're kind of agnostic to that. And we think that, you know, there are times when, if we think that silver's in the midst of a big catch up and it's starting to catch up, then we can start allocating to the names that we own that are the high quality assets that have a big weighting to silver.
If I can provide a slightly different perspective on that, if you look back through monetary history the last 2,000-3,000 years, gold and silver had very distinct uses. Gold, because it's so valuable per unit weight, was used for capital transactions. You ransomed your king back with gold. You bought a ship with gold. Silver is much easier to handle for small transactions, right? You might buy a cow with gold or something much smaller. And so really silver is a transactional metal, and gold was a capital metal. And the way that plays out in the market is that in the Great Depression, when the banks collapsed, there were capital problems. And so gold did very well, but the dollar never ceased to be a good transactional unit of currency. And so silver totally collapsed in the Great Depression. It was a disaster, right? Whereas the opposite happened in the 70s. You had a credit collapse because of inflation, so gold did very well. You also had a transactional problem. I mean, apparently taxi cab drivers in New York City and laundromat people would run every day to the coin store and buy silver with all the cash because they didn't want to hold cash very much. And so silver was a much more liquid instrument for doing transactional metals. And so I think, you know, whereas gold goes up in credit collapses, be they inflation or deflation, or silver really only works in inflation or credit collapses. And so I think it's not surprising that in the first wave of this scenario, or 2008, the first is always deflation, right? I mean, the current, you know, the market collapses, prices go down, gold goes up because the banks are in problems. And then later, when the Fed prints all the money, as we look forward to inflation, which we all agree is coming on a CPI basis, that's when silver will go actually bananas and probably will catch up and surpass gold. But it's a very distinct bet, and as Chris mentioned, there are very few primary silver producers that are any good. So it's a much trickier thing to play. But you have to know what you're buying, and that's what you're buying is a transactional metal to help transactional problems.
Interesting angle. Adrian, do you own silver stocks?
Yeah, we do. And I mean, just to follow up on that, there's very few primary silver assets, but there's equally very few companies where a majority of their revenue is silver. And so even, you know, some of them have changed their name, like Silver Wheaton changed the name to Wheaton Precious because they weren't finding the silver assets and their production is no longer silver. And that's, we won't name them all, but several companies with the name silver in them are not silver companies at all, but they keep the name silver because obviously when silver pops, there's so few silver companies that those companies also do very well. But generally, I mean, I look at a company and yeah, I mean, I absolutely agree 100% with what Dan said on the macro level about gold and silver, and not just agree, I mean, it's facts, so you have to agree. Difficult to disagree. But, you know, I don't really mind whether it's a silver silver deposit or a gold deposit. Again, as Chris said, if you're buying a deposit, if it's a good deposit with good management, it doesn't really matter.
Okay, and Larry, do you want to sum up the final question and tell us that silver's going to?
Yeah, it's been well covered. I'll just add that silver is the greater optionality metal. It's gold on steroids. There's a lot of volatility in gold and gold equities. I mean, put in silver, which moves faster, and then put in silver equities, which move even faster than that, and you've got real rocket fuel. Hard to find good pure silver plays, but when it's working, it's working. I think one thing that is interesting to point out is that the world uses silver for industrial purposes, so it's got that piece as well. And also, there's really no big stock of silver sitting around. I mean, all the gold that's ever been mined is either in a vault or around some woman's neck. And, silver's getting absorbed every year. And so, we mine 800 million ounces, we use 800 million ounces. And so when, at commodities priced at the last one sold, right? So when a bunch of demand shows up and says, hey, we need to make solar cells and we need silver for the input of this mechanic or this electronic device, and there's not an ounce around, bingo, the price goes up and it goes up big. So, I think people should be in silver. I am in silver. My fund is in silver, recognizing though that it's extremely high volatility. It's rocket fuel.
Well, that what a great way to sum up. And gentlemen, thank you all very much indeed. I think we're out of time. So I certainly enjoyed this hours. And I suppose in short, we've got a clearly positive macro that has been painted by all four of you. One or two interesting aspects and differences. I love the difference between the 2008 to the current situation, which Dan highlighted. I thought it was interesting to hear about your views on M&A. I think if we were 10 years ago, we would be saying that M&A was literally about to go berserk, and I think there's still going to be some time from what you're saying with M&A, but it is coming down the line, but perhaps a little bit more restrained. And CalPERS is perhaps the key to igniting everything and getting some money out from newer sources that I think we've all been looking for some years. So I would sum up on that, and I would really, really like to thank you all and also One-to-One for putting on hopefully a great conference, and hope to see as many of you as possible in reality at some stage in the near future. So on that, thank you all very much indeed.
Thank you.
Thank you.
Thanks for having us.
Thanks for joining, everyone. Thanks, Jamie, for hosting that. Cheers, guys. Take care.
Thanks. Great.
Thank you.